Energy-driven inflation is pushing global bond yields to multi-decade highs, just as equities lean harder than ever on artificial intelligence and earnings momentum. Welcome to vTalkInsight, Allocator's Lens Daily for May 19th, 2026. In equities, the core tension is between exceptional earnings and AI momentum on one side, and rising discount rates and energy costs on the other. Headline indices in the United States are still close to highs, even after recent pullbacks, because profit growth has been far stronger than expected. Year-on-year, S&P 500 earnings growth is running in the high 20s, and estimates for this year have been revised higher over the past couple of weeks. Semiconductors and AI infrastructure are central to that story, with NVIDIA's revenues expected to grow more than 70% and its market value and options pricing turning its results into a market-wide event. Valuation metrics, though still described as reasonable for some AI leaders, are rich at the index level, with price-to-book and price-to-sales ratios around historic peaks and gains concentrated in a small group of megacaps. Most diversified active equity funds are lagging the main benchmark, a sign that breadth is narrow and that many allocators are underexposed to the winners that dominate returns. At the same time, macro risks are building around them. Global bond yields are at multi-decade highs. European equities are under pressure from stagflation worries, and higher oil and refined product prices are starting to weigh on travel and consumer-facing stocks, even as they boost listed energy producers. For multi-asset portfolios, that creates a danger zone where strong earnings and AI narratives can coexist with rising downside risk if rates or oil lurch higher again. Upcoming results from NVIDIA and from major retailers, plus fresh signals from central banks, are likely to be the main catalyst for the next leg in equity multiples, making it important to watch how equities trade against moves in long-dated yields and in crude. Turning to rates, the story is one of structural repricing to higher yields as inflation proves sticky and the energy shock persists. United States 10-year and 30-year Treasury yields have broken to levels last seen before the global financial crisis, with similar moves across the United Kingdom, continental Europe, and Japan. Recent upside surprises in inflation data, combined with Brent crude trading around $110 and refined fuels rising even faster, are feeding expectations that central banks may need to keep policy restrictive for longer. Rate markets are flirting with the idea of an additional Federal Reserve hike, or at least an extended pause, and some commentary points to the risk of a more hawkish stance from new leadership if inflation does not ease. Behind the inflation story sit mounting fiscal concerns. Global debt has climbed into the mid-300s of trillions of dollars. Deficits are on unsustainable trajectories, and foreign official buyers such as China, India, and Brazil have shifted from accumulating treasuries to selling them, leaving market-based buyers to demand a higher term premium. That combination has driven a yield shock at the long end, while the front end is partially capped by political pressure to avoid destabilizing funding costs. History still suggests that in recessions, high-quality bonds often deliver positive returns, and today's higher starting yields provide more income cushion than in recent years. But the path to that protection may involve elevated volatility and further bouts of selling. For allocators, the key questions now are how far term premia extend, whether inflation expectations continue to drift higher, and how fiscal authorities respond to market pressure. Incoming central bank minutes, the composition of inflation surprises, and any change in Treasury issuance plans will be critical markers for whether today's yield levels prove a ceiling or just a staging post. In credit, carry remains compelling and primary markets are active, but early signs of strain are beginning to emerge beneath the surface. Corporate issuance is running hot, including from large technology firms funding data center and AI investment, and retail flows into fixed income stay robust, particularly in higher-yielding segments and emerging markets. Yet high yield and private credit are not behaving as smoothly as investment grade. Listed business development companies have rolled over. There are concerns about redemption-driven selling in some private vehicles into June, and spreads between weaker and stronger borrowers are widening, especially where business models are exposed to higher funding costs. European banks illustrate this divergence. On paper, steeper curves and higher rates can support margins, but names in Italy and the United Kingdom are under pressure as markets focus on stagflation risk and local political uncertainty, reviving memories of past episodes of sovereign bank stress. At the same time, corporate and household balance sheets are generally healthier than before the financial crisis, with lower leverage and longer-dated liabilities, which may delay default cycles even as yields rise. For multi-asset allocators, credit currently offers income but also acts as an early warning system for the interaction between higher-for-longer rates and real economy cash flows, making sector and quality differentiation more important than headline spreads alone. Foreign exchange markets are quietly signaling shifting views on policy credibility and fiscal risks. The dollar has not delivered the kind of outsized safe haven rally seen in previous crises, despite elevated geopolitical tensions and a sharp move higher in global yields, reflecting some reassessment of the United States' fiscal path and policy consistency. By contrast, sterling continues to carry a visible risk premium. Rising gilt yields, debates over fiscal loosening, and ongoing political uncertainty have kept pressure on both United Kingdom bonds and the currency, with markets explicitly wary of a repeat of past episodes where fiscal announcements destabilized rates. The gradual shift of some emerging economies away from accumulating treasuries and toward alternative reserve choices has added to the dollarization debate, even though the greenback still benefits from higher yields and strong nominal growth. For emerging market and international allocations, this mix means currency risk is increasingly tied not only to local growth, but also to each country's energy balance and exposure to geopolitical flashpoints. From a cross-asset perspective, watching how the dollar trades against commodity currencies and how sterling responds to domestic headlines can provide useful confirmation or contradiction of signals coming from bonds and credit. Those currency moves form a bridge into the asset class that is currently driving much of the macro narrative, commodities, and especially energy. Commodities, and oil in particular, sit at the center of today's macro risks. Brent is trading around the low 100s. Gasoline and jet fuel prices are rising even faster than crude, and cushions from inventories and strategic reserves are described as largely exhausted. The backdrop is an increasingly unstable Gulf region. The Strait of Hormuz remains partially constrained. There is a tanker backlog near Iran's main export hub, and a new authority in the Persian Gulf is effectively imposing tolls and selective passage on oil flows, all while Iran retains significant missile capacity that could threaten key energy infrastructure. Physical cargo prices remain elevated even when paper benchmarks briefly soften, pointing to ongoing tightness in real supply. Scenarios are being discussed where oil holds around $120 into the second half of the year, or even spikes toward $150, which could trigger a second major inflation shock before slower growth shows up in the data. These dynamics create clear sector winners and losers. Energy producers benefit from higher prices and, in some cases, are still able to raise fresh equity and debt to fund growth and energy transition projects, while airlines and travel companies are already cutting capacity in response to soaring jet fuel costs and thin inventories in Europe. For allocators, energy prices now function as a key swing factor for inflation, rates, and earnings all at once. Progress or setbacks in diplomatic efforts around Iran, changes in Gulf shipping conditions, and signs of either further inventory draws or unexpected supply additions will likely shape not just commodity returns, but also the path of bond yields and equity volatility in the months ahead. Across assets, the picture is one of strong but uneven fundamentals meeting a more hostile macro and geopolitical backdrop. Equities still lean on exceptional earnings and AI-driven growth, yet face growing sensitivity to long-dated yields and to oil, while rates are adjusting to the idea that structural inflation and fiscal strains may keep nominal yields elevated. Credit continues to offer attractive income, but early stress in high-yield, private credit, and some banking systems shows how quickly higher for longer can test weaker balance sheets. In currencies, the safe haven playbook looks less automatic, and in commodities, energy remains the fulcrum that can tilt the whole cross-asset narrative toward either controlled adjustment or a renewed inflation shock. From here, the key markers to watch are the next leg in oil, the behavior of the long end of yield curves, upcoming AI-related earnings, and any sign that credit stress is broadening beyond the weakest pockets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.